12 noon, and we've got a great series for everyone today. I'll just make some introductions real quick as people trickle in. But today we're going to be going over year-end financial moves that to really close out the year strong, and then kind of segue into how we can plan for the future going into 2021. And so today we're honored and excited to have Joshua Ritchie. He's the Director of Development at Thrivent Financial. He's going to bring the perspective of the financial planner. We've got Al Danto on the panel. Everyone knows Al, Managing Director of Exit Advisors, professor at Rice. He's a certified valuation analyst and expert in valuation. And then Gary Cooper, also the Managing Director of Exit Advisors, President of Cooper CPA. He's also a CVA, and clearly he's a CPA. So he's going to cover this from the tax perspective, and I think we'll try to tackle this from all angles. Should be a really good presentation. We encourage the Q&A. So, we have a lot of kind of themes and questions we want to address to the panel, but if you have something burning or that you'd like to talk about, please submit it to the Q&A feature. It's at the bottom of your screen. Pretty familiar with that, and we'll try to answer it live or at the end. And try to be interactive. This is for you. What else? So I've kind of said this before. We've been doing this since the pandemic started, and I think we've got this and maybe one other before we close out the year, and we want to close this out strong before we take a little break over the holidays. But today really kind of focuses on what we pride ourselves around: education. Coming to you as not only the M&A advisor, as you've heard me say a million times, but also the preparation side before you have a transaction. And this kind of also plays into the preparation after a transaction. Once you close a deal, how do you safeguard everything? What are the maneuvers that you can make from a tax perspective? So this kind of all ties into that, but we really do pride ourselves on our content and the educational approach that we take to really not just preparing for a transaction, but preparing your business way ahead of time to add value to it, and to maintain and keep that value. So I heard a really good analogy from a friend a few months back, that you can make all the money in the world and sell your business, but all of a sudden you get this bucket of cash and it starts leaking out. How do you kind of hold those leaks in? And so some of this is relevant to that. But anyways, I'll kick it off. This is kind of a question. Let's start with just the whole general concept of year-end moves, and let's focus on taxes. And maybe Joshua, maybe you kick this off, and then Gary can kind of tie into it from a tax perspective. But what are some good ways or good tax maneuvers that we can make for the end of the year?
Yeah, and I just want to say thank you for having me on here. Taxes are interesting. I would say, especially in December, one of the things that can be done to really, facilitate and put yourself in a better situation is to consider how you're promoting generosity and how you're giving. A lot of folks tend to make a lot of cash donations, I would say, at the end of the year. Grandparents tend to do the same thing with grandkids and that kind of thing. What I would suggest and have anybody on this call consider is doing something with securities. And so, for example, if you have any stocks, mutual funds, or any type of security that's had a long-term depreciation, so you can really give about 20% more because you're not handling and dealing with capital gains by gifting stock. Most major portfolios, most major companies that are out there that handle this do have a way for you to essentially donate and gift stock back to the organizations and groups that you affiliate with. The benefit to you doing that is that you can get essentially a tax write-off for doing it and a deduction, just like you would with cash. But again, you mitigate the liability to yourself from a tax perspective. So that's one thing that I would heavily consider if you're in the habit of doing that at the end of the year. This year's a little different from a retirement perspective. Typically, once you reach 70 and a half, you have to consider taking required minimum distributions at the end of each year. And so that's based on really a kind of a life expectancy factor that's determined as well by the amount of money that you've saved. This year, those are waived. And so there's a benefit in not having to consider that this year. What I would say is consider how you're going to do it next year. A lot of folks get into November and December and they start to think about when and how they're going to withdraw money from these areas. What I would say is don't always backload it, because then you're putting yourself in a liquidity crunch. You don't know what the market's going to look like in November, what it's going to look like in December. Consider doing it earlier on in the year, and planning more appropriately that way. So those are two areas that I consider when it comes to taxes.
Gary, any thoughts there?
Well, to add to that, I think is harvesting losses. So we've had a very volatile market, and you could have been playing the stock market, and you could have some sizable gains. And this is something where you need to go to your advisor. You need to see what it looks like today. You may have some unrealized losses sitting there, or maybe in some other assets that you could sell to offset those gains and not pay taxes in 2020 for that. Something else, I guess, is somewhat related is Roth conversions. So if you've had a tough 2020 as a result of COVID, a lot of businesses have really suffered, especially small businesses. You may have some traditional IRAs sitting out there that you could convert to Roth in 2020. Put yourself in a position for tax-free distributions down the road. Converting those over, it's going to be at lower tax rates, because at this point, with COVID, with the stimulus checks and everything that's transpired, I got to think taxes are going to go up no matter who the president is. We're not sure where yet. We're thinking capital gains could be affected. There could be some type of wealth tax. Quite candidly, I think the tax increase will have to be across the board in some way. So I think you need to look at smart ways maybe to take some money off the table potentially in 2020, even with we only have a few days left. I mean, after December 31st, guys, it's history. So that is the critical element of tax planning. It's really funny. We'll call people and say, hey, we need to do a tax plan. Yeah, let's meet in the second week of January. Well, okay. Well, I'm not sure there's a whole lot we can do for you at that point. If we meet then, it really, you need to get in touch with your CPA. It is so very important. I mean, everybody that we put a plan together for, and I mean everybody, we find ways to minimize taxes. And if you press your CPA, they should be pressing you right now with all the COVID law changes that have taken place that you could benefit from, and just a roller coaster year. So I think from an investment, and also I think, Joshua, you were going to talk about alternative investments too, some things that you could possibly do before the end of the year. Kind of touch on that.
Yeah, I'd be happy to. And I think a lot of this pertains to where retirees are right now. So if you're entering retirement, nearing retirement, or considering living off of your portfolio, this is a tough time. Typically, the way it works for those that may not be as familiar with personal financial planning is the younger you are, typically you're going to take more risk because you can handle the ups and downs of the market and handle the volatility. When you get closer to retirement and you have to actually live off of those funds and start distributing it, you really need more of a steady, low return that you're not going to see the volatility or liquidity issues. So, an example of right now, things that would typically give you that lower steady interest rate are things like bonds, CDs, and any interest-bearing investment. The problem is, if you look at our current interest rates, some of those are returning 2%, 3%. And that's really not enough to live on. The problem that folks are running into right now is saying, well, then what am I supposed to do to generate income on my portfolio? If I need to live another 30 years on this money, and I would even maybe like to leave some to my kids, or, you know, the things that mean the most to me, how am I doing it? And so the areas that we're seeing a lot of, I guess, alternative investment and change are things like real estate. If you look at real estate prices right now, they've been relatively unchanged. One of the reasons is mortgages are so low. It's almost like you're, relatively speaking, being paid to take the house. It's very cheap to finance at this point. And so considering that is one area where a lot of retirees and uh, folks getting close to retirement are considering an investment. Another one, and this is slightly more, I guess, it's a little different. There's a lot more consideration being taken into things like annuities. Annuities tend to be a little higher expense, so you're pretty much paying a premium to have an assured paycheck at a set interest rate. And so one of the issues there is people are willing to essentially pay the extra dime to get, you know, a little bit of an extra interest rate. What the problem with both of those investments, of course, is that you're taking on something that's slightly more liquid than you normally would. So you can't just pop out of it when you want to. And so we're seeing just a little bit of different, investor behavior these days. And I think that, it's just interesting to see that the old dividend growth strategies of Johnson and Johnson and some of these stocks are feeling a little less certain, and people are fleeing to different asset classes these days, Gary.
It's really interesting too, Joshua. We must bring out this the interest rate right now. You talked about the low interest rate on investments, but you got to look at the low interest rates right now for real estate and other potential purchases. I think my son told me today, and I'm not sure it's true, if mortgage rates went below 2% for 15-year fixed, and even with the banks, the prime rate. I know, some people weren't alive to see 24% interest. It was a long time ago. I mean, back, that's an antique. But, I got to think with taxes, I got to think interest rates are going to go up. So this could be a good time for a purchase. And I guess going along with that, just kind of bring out cost segregation studies with that. So you purchase, let's say you've got a company, you can own your own building, owner occupied. Banks love those type of transactions. If it's something you could pull off in December, if you've been looking and you've nailed down, a transaction that you think would work for you. The cost segregation study is something, it's an engineering study. And I know a lot of the new clients that we receive in the accounting practice have no clue what that is. And it's an engineering study, and they're quite reasonable now. You could have one performed for $5,000 or so. And I mean, you're talking about separating out such things as plumbing, electricals, ceilings, flooring, things of that nature in a building you purchase. And a building has to be depreciated over 39 and a half years. But what the study does is qualifies for 5 and 7 year. So some of that would also qualify for bonus depreciation. So this could be a really good way to really knock a hole in your tax liability for 2020 as well. So it kind of goes hand in hand with the investment opportunities.
Yeah, and the same could be said for equipment or even any sitting inventory, right?
Yeah,
there's opportunity there.
Well, some interesting points. I mean, equipment, obviously you got bonus depreciation, you got Section 179, which are very liberal in 2020. We don't know what's going to happen in 2021. So, the opportunity to accelerate that depreciation is very, very beneficial. And it's something that you should consider. I mean, right now you're looking at, well, do I buy it 2020 or 2021? Well, again, we don't know what the tax laws are going to be in 2021. Kind of like a bird in the hand is better than two in the bush sometimes. So it's something you may want to focus on. I'll look at tax planning in an interesting way. I mean, you've got a straddle, because now you've got kind of 2 years that you got to look at. What is next year going to look like? What's this year going to look like? Or tax rates going to be higher next year? So, I mean, you could potentially go in the opposite direction. Do you defer spending in 2020 based on what your income looks like and your standard tax rate, and hold off and spend that money in 2021 where tax rates may be higher. Same thing with income. Everybody talks about defer, on their income. Well, maybe accelerate income. So I think there's some interesting points, kind of unusual to the traditional tax plan coming up for the end of 2020.
Al, how about from a valuation perspective, not necessarily looking into the future just yet, because we'll touch that, but any like closing things that we should tell businesses to do now before the year's over?
Yeah, there's a few things that you can look at. I can kind of add to what Josh and Gary said from a business standpoint. So there's times if you're considering gifting shares, putting shares into a family limited partnership. If you had a bad year, we worked with a client this year and they kind of had an off year in terms of cash flow. So we did a valuation, and there can be an arbitrage between a financial valuation that we do. So when we do a certified third-party valuation, it's based on the return of capital, right? The return of someone making an investment for the risk that they're taking. There's no strategic benefit. We really don't look at a whole lot of growth when we look at it. It's discounted back a little higher. So it's getting a little late in the year, but this is something, if it were, a year where you had lower income, lower profits, then it could be a time to give shares, potentially put them into a family limited partnership. Again, something that's got to be done fairly quickly at that time. I would just like to say, have a strategy. This can get very complicated. And you don't know what you don't know. Gary knows a lot from a tax standpoint. Josh knows a lot from a financial planning standpoint. I know a lot from a valuation and M&A standpoint. And when you're a business owner, all these things intertwine. So you have to have a strategy around these. And the worst thing that we hate to see is somebody that comes to us, and say, man, it's too late. Like Gary said, hey, it's January, you should have done this last year. A lot of people, a C corporation, right? There's a thing called a 1202 election, where if that's your shares, your originally issued shares, and you sell the company, you pay zero tax on it, zero capital gains taxes. With the potential, and I'll talk about it a little bit later, of capital gains going to ordinary income, that could be a 40% difference in what you take away, just because your corporate structure. And corporate taxes are lower than personal taxes. So the form of entity, where you're at, how you make the choice, it really matters. It's really important to have an overall strategy and plan. And depending, where you're at, the client that converted to a Roth, we did a valuation converted to a Roth, they don't pay any future taxes on that, on dividends and income that comes in. Yep. So they were able to value this asset very low, and as they go forward, they're getting most of this tax-free. So there's a lot of strategies that are out there that, man, I've done this all my life, and Gary's done all, and we learn, we constantly learn, and we learn of a hybrid. You can do this and do that. Opportunity zones that are out there. Like Gary said, if you're going to take capital gains now, you can roll them into an opportunity zone. So you might take a sale. So there's a strategy, and it's different for everybody. So it's really important to have a strategy and a plan. Go.
Al, something else on the valuation, but they tried to do away, and this is something you could possibly elaborate on. About 3 or 4 years ago, they tried to do away with the lack of control and lack of marketability discount. And I think that's something maybe, touch on, if you would, how that could affect gifting and how it could affect gifting in 2021 if they do away with those discounts.
Yeah, that's a really good point, Gary. So when you gift shares, you don't gift them as a prorated amount of the valuation. So let's say you had a company that's worth $20 million and you decided to give put in a family limited partnership, give equity to family members, and you wanted to do 25% of that, right? So $5 million. It's not $5 million. You have a discount of about 30% for lack of marketability. because those individual shares, they can't decide when to sell them, and lack of control another 30%. On average, they can be higher. So you could give 5 million, what would be 25% of the company, but it may only be $2 million in taxable income because of the valuation, because there's a further discount for shares that are not marketable, or they can't make the control decision. So really important. And then theoretically, you could take something like that and put it into an opportunity zone and pay no capital gains with the strategy as you move forward. So there's a strategy for everything.
On the subject of gifting shares, Gary, you touched on this on your presentation a few weeks ago. Actually, a month ago when the election was being finalized. But the basis step up and how that could affect business owners who want to give shares to their, to their heirs or to whoever their successor is, family, whoever it might be. Maybe you could just touch on that again so we can refresh everybody.
Are you talking about gifting like to a family limited partnership and having a discount that Al just kind of touched on, like a control and marketability?
Yeah, but I guess if I'm not mistaken, is there not going to be a full, as proposed, it's not finalized yet, but a full step up in basis to the market value? So
I know
you would have a huge.
Yes, that's I'm not sure this tax law will change or not, but it'd be horrible if it does. So when you received upon death, and then in the will process, right now, when you receive an asset as a beneficiary, it stepped up in basis to market value on the date of death. Okay, so right now, the lifetime exemptions right at 11,400,000 per person. So husband, wife, what, 22,800,000. Well, back in, I think the lowest I've seen it was 2001. It was 675,000. So you can see that's really low as far as lifetime exemption. So also they're looking at when this asset is left to the beneficiary, transferred at original cost basis. So how this would work out, let's say you get your parents' house, and let's say today that house is worth $1.5 million, but let's say they bought it 40 years ago for $200,000. I mean, so right now when you get it, it'd be $1.5 million. So if you sell it, there's not going to be a capital gain. But if it gets transferred to you at cost basis at $200,000, now all of a sudden you got capital gains. Now, elaborate on what Al said. What if they do away with capital gains taxes? So, okay, now you're paying 40% on that asset when it's sold. So as you can see, that could be quite an increase in your tax liability just from those little things that you really don't see on the news, you don't hear on the news.
Yeah,
that's the type of granular information you get from people like us, that can provide that to you.
It's like
So
it's a double hit. It's your tax rate's going up, but also how much you're getting taxed on goes up too.
Well, it's a wealth tax is what I look at. So let's face it. I mean, the lifetime exemption should even be more than 11 million for now. Based on where the economy's grown, the inflation that's been experienced over the last 25 years and such. I mean, really a lifetime exemption should probably be more like $50 million. But, I think what I understand, I can't remember the exact dollar amount that Biden's looking at, but I think it was somewhere around I can't even recall, a couple of $1 million taking it down. So
you think it might go down that low, Gary?
I mean, it could. I mean, they're going to have to try to raise taxes. And so, why not raise it from somebody who's passed away I mean, instead of somebody who's alive? So it's very possible.
And well, to piggyback on that, one of the things that we in kind of financial planning tend to work with, and it's the morbid stuff no one wants to talk about, and it's liability and it's estate planning, right? And
Yeah.
so it's working with folks to say, hey, instead of someone receiving that house and having that 800,000 that they're going to get taxed at, consider gifting, consider buying life insurance policies. For a lot of small business owners on this, and I'm sure y'all hit on this all the time, but having a buy-sell insurance agreement. So if you have a partnership where you have 2 or 3 people, the last thing you want is someone's grieving spouse to be the decision maker in your business. The last thing you want is to have someone's grandkids or kids that have had no interest in the business suddenly being decision makers. And so using some of that capital to have it to where, let's say Al, Gary, and I are in a business together. We all have insurance policies on each other for, 500,000, $1 million, whatever you want to call it. So we can buy each other's interest out with an agreement that says, if Al were to pass, Gary and I are going to be the co-owners of the business. If I were to pass, Gary and Al are owners of the business. And so I heavily encourage anybody that is a business owner on this call to consider instituting something like that, or making sure that your articles of incorporation are set up in a way that, your family and your business partners know what's going on, because it gets very hairy, very complex, and there's a lot of emotions involved. And unfortunately, nothing's guaranteed. And we've seen a lot of that throughout 2020.
Yeah, that leads me into also, Josh, with the importance of a good company agreement or operating agreement, if you do have partners, and having a buy-sell a component of that. But, we see some pretty ugly, what I call business divorces, to where people have a very sterile operating agreement. They don't have adequate buy-sell provisions in it. And it really leads, you're in love when you form that business, but you're protecting each other from one another, and you're protecting each other from divorce, death, things of that nature. So it's critical that you take a look at that and see what it looks like.
We had a question that was on, what number can I retire on? And I think that's very specific to what your needs and wants are. But I think we've covered a lot of maybe how you can protect the number that you get to. How do you get to your number? How do you protect it? Do you guys have any closing remarks on, once you've retired, maybe protecting and safeguarding?
Yeah, that's tough. One of the things that really to echo both Al and Gary is to, of course, talk to an expert. Whether it's someone that's an expert in valuation with taxes, or like myself, that's a financial planner. Get with a financial advisor, a financial planner. It's never too early. You can be in your 20s, can be in your 30s, and much to Al's point, don't do it when it's too late is the point. You need to know your number, and you need to understand, what the future value of your money is going to look like, as well as present value, to understand, that $1.5 million that you think you need. Well, given inflation over the next 20 years, is it really going to be that? It's probably not. The other part of it is you have to understand what kind of liquidity and risks you're going to need. And then the last part is understanding the vision of what you want for retirement. Some folks want to go fish on a lake with a cabin in the woods, and that's perfect. Others want to travel the world, and those are very different visions, and very cheap and expensive ways to retire. So you have to make a decision on what that is and how you want to achieve it. The last thing that I would say on that is it's really crazy to look in retrospect how similar 2020 can be to 1920. So historically, of course, we remember the Roaring 20s. Previous to the Roaring 20s, 1918 to 1919, 675,000 people died of the Spanish flu. So they were also overcoming a pandemic. And one of the interesting things about that is that there was an influx of spending and entertainment. And that's, I think, something that we're going to see next year is people are going to spend a lot of money being able to go out and about. And once these vaccines kick in, do the things they used to love doing. But I do think there is going to be some hyper savings post-pandemic, just like there was after 2008, where people realize, our lifestyles are fragile and we want to hold on to what we have.
It's a really good point, Josh. I'd just like to say for the business owners that are out there, and Josh touched on it. Really understand what your end game valuation is going to be. I've talked a lot about valuation in previous webinars that we've done, but man, the average small business in America sells for a little under 3 times cash flow. And then you pay your tax and you take it away. But there are some things that, again, average is a middle point, and what really is going to put you to the higher end of it. And just because someone's business in your industry sold for this doesn't mean that yours is going to sell for that. It can change considerably, and industries are different. You know, we were on the phone this morning with someone in a very high. They're sold in values of revenue, multiples of revenue, recurring revenue, software as a service. It's a toll booth, and high valuations. And I get business owners to come, well, so-and-so's business sold. Yeah, but you do software development. You're only as good as your next job. You're not even going to sell for 2 times cash flow. And so, again, it's this whole kind of end of the road situation. Sometimes we're kind of like doctors, and someone comes in I turned 60 last year and try to stay in good health. But sometimes someone comes in, man, you're high cholesterol, your blood pressure is high, you're overweight, and you're in tough shape. And it's the years of, kind of abuse and not taking care of it. And others come in that are great shape and say, man, you're going to do just fine. Your valuation may be more, but set that plan up years ahead of time. Understand what your target's going to be. Understand what the valuations are in your industry. Understand what it takes to get an above market valuation. Be realistic, and then aim for that target. And then when you start to get to be in your 60s and 65 years old, there's some other moves that you make to increase the value of your business at the end. But it takes years of doing things right I see that, Robert. Yeah, I'm pretty old. Hard to believe. But you get to that end, and you want to understand what that is, right? So understand valuation, understand where you're going to be and what you can expect, and it makes, when you get to that end game and you come to someone like Josh and say, hey, I'm going to have $3 million to put away. I'm going to have $5 million to put away. And he's going to say, well, this is what you can afford to do. This is your lifestyle. This is where we need to be. So it goes hand in hand.
To touch on that too, Al, it's just that I tell clients, the day you open your business, you should have a plan to sell it, right? And nobody has that target. They don't look at, well, what's my end game? What is my number? We talked about that loosely. What is your number? And it just trying to have a continual succession plan set up. And one thing that we talk about at Exit Advisors is you don't know when you're going to have the knock on the door, from the purchaser, or maybe the knock on the door from the Lord. So, it can be one of those knocks, but if you're not ready and you don't have in mind what you want, and then someone like Joshua can certainly help you with what your number is. I mean, how do you invest that? What do you put your money into, and be able to do the traveling, go fishing every day, do the things that you love to do. So it's, I think, having that data room set up and having your information very clean and organized and prepared at all times is something, and especially with this year, something I wanted to touch on is accounting records too, is, this is a good time to make sure you got everything shined up. You go back, you have somebody help you look at 18, 19. I know Al was going to talk about 2020 is kind of an anomaly. It may be thrown out, but, have it go in and get prepared.
I want to segue into kind of the planning now for 2020. And I think part of the planning process is breaking the status quo of what you're used to, being able to be adaptive and dynamic in a new environment. So I'm gonna go back to Al, and I want him to elaborate a little bit more from the business valuation perspective on some resolutions, if you will, for 2021 to get off to a good start. And I think a good place for you to start is, you were talking about breaking the mold of the average company at 3x, 3 times earnings. What are the low-hanging fruit, if you will, that businesses can do now or planning in 2021 to start cleaning up and increasing their valuation or their valuation multiple?
Yeah, let me get that. Maybe what I can do, and I'm not sure if I'm going to have a chance to get here again. And I've kind of prepared some data
Yeah.
and even a slide. So if you could let me share my screen here, I'll share. But I want to touch on kind of where we see the M&A market, where we're at, and where we think we're going to. Can you see this slide?
Yeah.
This is really interesting. So if you look at what happened in 2008, you go back to 2001, we see this incredible pent up demand that happened. So 2001, obviously things went down. This is the M&A market, and then it skyrocketed. Oh, I moved my graph. It skyrocketed up. 2008, 2009, same thing. We saw this spike. This is 2020. We're seeing this really strong downturn. So we expect 2021 to be a really big year. And I was talking to Josh earlier about this, and this part of the reason is there's a 2019 was strong as we came up. The first quarter of 2020 started out really strong, and then it got put on hold. Everything got put on hold. So what happened when it got put on hold, we had a lot of cash that got built up. There's $2.5 trillion of private equity dry powder right now. It's the largest ever. $2.4 trillion of cash on U.S. corporate balance sheets. It's the highest in decades. The credit markets, like Gary said, extremely, extremely low. So from an investment standpoint, from a fundamental valuation standpoint, that's going to increase demand. It's going to increase valuations. So we see combined with this pent-up demand in 2020, we see a really strong 2021 coming up. Here's some of the challenges that we see. I think this certainly a COVID hangover. Everything kind of what drives confidence, what drives higher valuation, what drives M&A activity is confidence. Obviously, we had a lack of confidence, lack of clarity, lack of uncertainty. We're coming out of this. We've got a vaccine coming out. Was said earlier, people are ready to go out and kind of start dancing in the streets and celebrating and getting out there. So we're seeing this come, but there could be a COVID hangover for certain companies. If you can show, man, hey, business is strong. We got through COVID. First quarter's coming out strong. Second quarter's coming out strong. It's going to be really good. It's going to be an increase in valuation. What I think is going to sneak up on a lot of people and a lot of potential sellers of the business are these capital gains taxes, because it looks like, and Gary can kind of back me up on this. I'm not a CPA, but if we get to this wealth tax of $1 million or more, and you sell a business for say $5 million, the potential capital gains is 40%. It's a huge, huge number. So again, this pre-planning that you can do to think through this, because you can't do stuff at the very end of the game. You just can't. You can't just go backwards. You can wish, but you can't go backwards. So can you work with someone like Josh, move shares into a family limited partnership, transfer the shares, take advantage of that? What can you do? You're going to have a strategy around. I think if this happens, it's going to catch a lot of people by surprise. That's going to be an asset sale or a stock sale. So it's going to be really big. Andrew, to answer your question now, where are we at now? What can you do? Again, I think the theme of our message today is get your house in order, have a plan. That's it. So clean up books and records. Year end, make sure that your expenses and your revenues mirror this year, 2020, right? Mirror it. Next year, close your books out on a monthly basis, a regular basis. Consider an annual review or an audit. It makes a huge, huge difference. Start to clean up and secure documents in like a secure Dropbox box, your financial records, your corporate records, your leases, your contracts, your legal. Take the time, maybe over, winter break, between Christmas and New Year's, and go in there with your team and clean this stuff up, clean it up. It makes a huge difference. And then once you get it done, it's kind of like having a clean garage. It's a lot easier to keep it clean, keep it that way. If you're really involved in the business day to day, get out of the business and remove yourself from the business. Have a management team. There is nothing that really impacts value more than that owner that's the business, right? We've talked about this before. Is there a way that you can get kind of this recurring revenue? Any way that you can get recurring revenue, stickiness, so you're not just only as good as your next job, right? And take the time to review all your costs. End of the year is a great time to go back, and we just have stuff that creep on us. We had a great client this year who runs a great business, but during COVID, they went and looked at all their operating expenses, their processes, their systems, what they were paying for stuff. And it was amazing. They cut several percentage, out of their expenses, added that to the bottom line, and significantly increased their value. Try to have a process from start to finish. A really good friend of mine, Dave Linda, ran a closet company, and he was a process engineer. And he said, my goal was to say when a lead came in over the internet till there was cash in the bank, it was process oriented. I had nothing to do with it personally. Zero. Nothing will increase. He had so many people, bidding on it. We had a frenzy for people that wanted to buy it just for that fact. He didn't depend on him at all. And I'll end it with this, set goals. Set some resolutions for next year, for your revenue goals, for your expenses. Also, there's a thing, and Gary can help you with this, your CPA can help you with this. This is online. Your ratios. Know what your business ratios. What's the gross profit margin in your industry? What's the average you spend on advertising costs? What's the average net income percentage? It's kind of like a scorecard. It's like comparing batting averages, in Major League Baseball. You can go out there and get the averages for your company and see where you stand. So that's my year-end kind of where we're at and comments on resolutions going forward.
We've had a couple questions come through, and I want to try to fit them in where they're relevant. And one of them was from Rick, and he was talking about kind of inventory and supply chain management going into 2021. His example is, he was very positively affected during this time, during COVID, the sporting goods industry, specifically bicycles. But, there's kind of some storms on the horizon in the future with supply chain management, where you're getting your parts and how likely you will be to fill orders and what demand will be. So do we have any commentary around, supply chain management, especially if you're dealing with overseas vendors, China in particular, maybe?
One of the first things that came to mind for me, and again, this is from like a personal financial planning, so not an expert, Rick, in supply chain, but considering the next step of your business, right? Resale. And so people are going to be selling back bikes after this pandemic when they realize that it wasn't for them. In an example, I see with the MS 150 every year, some people go out and buy these $1,000, $2,000 specialized bikes. They ride it for one season and they're like, this isn't for me. And so then suddenly you have a bike that's professional level at a fair discount. And so considering that to be like a next step in how you run your business could be lucrative, but it would you'd have to have some cash flow to inject to buy bikes back, I suppose.
And if you were in I don't know that specific industry and how cyclical it is or seasonal it is, but if you did have a really robust year, one thing we look at, and this is just from my perspective, when we're talking to sellers and buyers, and they say, the seller's like, hey, look, we had this amazing year last year, revenue, we grew by 50%, and is that going to be predictable in the next year, and the next year, and the next year? And it's hard to control that. It really is. My suggestion would be, if you can somehow smooth it out or find operational efficiencies to, you can deal with pricing. If you can't control your inputs and the materials going in, You can control pricing to some degree without deterring your clients, but you can also try to improve your operations to keep your margins the same, whether, revenue is a little bit cyclical. If your kind of bottom line is steady and you're doing really well because you've improved your efficiencies, that's a big way that you're not going to have these blocky, chunky years, because someone's going to step in and say, oh yeah, you had a great year last year, but the year before that was terrible and the year before that was good. You really want to try to smooth it out so that it's predictable.
Well, I think an interesting point that on Al's chart. So, next year, if his chart holds true, there should be spikes in entertainment. There should be spikes in other things that people enjoy doing. So if you're in sporting goods, you've got to also look at, what can you get inventory for today versus what you purchase inventory for tomorrow.
Really.
So as demand goes up for products, the cost of supply goes up, right? And so it could be, the other side of that is you pay property taxes on that inventory at the end of the year. So, you're walking a tightrope on this. But I'm an economics type guy. I mean, I'll pay a little bit of property tax if I think I have the inventory at the right cost factor, to have a better gross profit margin, correct? So I think that's something you've got to look at. Also, with the new president coming in, some of the tariffs may be taken away from China and such. So you've got to factor that in as well as product costs going to go down coming across border. So I know I'm bouncing all over the place, but these are just some factors I think you've got to consider.
And something from a
Again, it's
valuation.
really relevant. I think they want to know that.
Yeah, from a valuation standpoint.
Keep going out.
Yeah, from a valuation standpoint, the fundamental valuation is, as you decrease risk, you increase value. So what we look at as valuation analysts is any risk. So if your supply chain is 100% coming out of China, and there's a potential that you could lose that supply chain, you don't have a backup supply chain, then that's a risk.
Yeah.
And it can impact value. So it's important, especially as you start kind of preparing and getting, and we actually ran into this with a client that we have. It's in the transportation business, and their supply chain was from China, and the buyers backed off during COVID. They said, we have to wait to see what happens with this. It's a risk. And as you go through the valuation process and ultimately the exit process, every risk is going to get identified. And if you don't have a backup for that, it could potentially impact value.
That's an interesting point, Al. I mean, touching on company specific risk. I mean, having material suppliers, that is definitely company specific risk, and where your products are coming from.
Yeah. It can, you need, the important thing would have a backup. So yeah, we're getting in from China now because of X. Well, if we don't, then all the other people in our industry won't get them, but we can get them from manufacturer Y, which is in Dallas or wherever, right?
Yeah, I mean, it's a balancing act between costs. China might be the low cost producer, but you also have to have control over it.
Yeah, it's
so
the
you don't have
dependency.
disruption.
It's the dependency that creates the risk.
Yep.
So Gary made a good point, kind of focusing on, what the, not just what your inventory and needs are now, but maybe about tomorrow. And I want Joshua to step in now and talk a little bit about, we're going to go into the overall economy, which we've touched on, but really more specifically some industries that you think might be set to thrive or even struggle going into 2021.
Yeah, I'd love to talk a little bit about that. And I'll kind of make the disclaimer, but there's by no means is this a recommendation to go out and buy any of the companies or sectors, but things for you to look into and consider. To start out, just a couple statistics that I found interesting. I'm an avid reader of The Economist. That's where I typically get a lot of my market research. I find it to be very accurate and ahead usually of the cycle by about 2 weeks. And so, in there, they said that back in April, I think we had about 14.7% unemployment rate. And so the latest figures in October put us right under 7%, still at 6.9%. And so the majority of that is kind of low wage earners. And so there is still a piece of this when it comes to 2021 that I think is going to look volatile. I think there's going to be some difficulty. I would say when you look at economic growth, it's propped up considerably by consumer spending, which is why a lot of these stimulus objectives and discussion really have been taking place. We need people to spend money. That's the reality of it. Roughly 70% of growth is attributed to consumer spending. So when I think about areas of the market that I would consider rotating into, or some, has a cyclical upside right now, I think some payment companies are ones that are going to continue doing well. I think MasterCard, Visa, Discover, those are areas that I would probably pay attention to. People are still spending money. They're doing it online. They're doing it in person sometimes, and it's only going to increase. I think some of the big names that y'all already know, some of the information technology names are pretty big. I think we've shown that we have a heavy reliance on technology, and I think that's not going to change anytime soon. Obviously, healthcare is big. The other areas, and this is sort of the less attractive in terms of you don't see these big names all the time, but the two that I paid quite a bit of attention to is consumer staples and things like communication services. And so, we're looking at companies like Verizon, AT&T, stuff that have a relatively solid dividend. But I mean, think about during this pandemic, how much we had to rely on not just things like Zoom, but FaceTime, phone calls to see our family and friends, our business, business partners, our clients. I mean, that stuff doesn't go away. And in fact, typically in a downturn, that does do quite well. I mentioned a name earlier, Kraft Heinz. People keep buying ketchup. General Mills, people are still buying oatmeal. None of that stuff tends to change. And in fact, because it's kind of a less sexy name and people aren't really paying as much attention to it, those tend to trade at fairly reasonable PE ratios compared to things like Zoom or compared to things like Amazon. And so I think that there's opportunity in areas like that are being overlooked right now. And so what I would recommend for anybody that is new to the financial planning scene is, of course, talk to an expert. Come speak with me, a member of my team as a financial planner, consult one in your community. If you're interested in getting into something like active trading, look into paper trading. So paper trading is where you essentially have an account with a fake $100,000 and practice. Practice makes perfect. Become disciplined with an approach that you like. Look at a particular area or sector that you're very, very comfortable with and just see what you can find. But again, I think being prepared on the front end and talking to an expert is just invaluable. It'll do you wonders in terms of your long-term goals.
Yeah, I think really, really good summary there. And before maybe we start wrapping up, so we can have a few last minute questions at the end, to kind of summarize, from the overall economy standpoint, you touched on unemployment. These are things not necessarily affecting one particular industry, but everybody. And you said unemployment 6 to 7%. It's going to continue to be volatile. We know taxes are, regardless of the president, probably going to be going up. Al had mentioned this earlier about rates. Private equity still has to make a return. They've been kind of sitting on the sidelines. So there's a ton of money on the sidelines waiting to be deployed, dry powder, if you will. But we didn't touch on lending and bank rates. And I guess the panel, to everybody, do you expect to see interest rates kind of stay low to keep stimulating the economy, or do you think these are going to start to creep up on us and your cost of capital is going to go up as well?
It's a great question. And I guess that's another sector I'd look at is financials and banking. The cost to borrow right now is so low, it's nil to none. On an individual level, buying cars, houses, I mean, it's some of the cheapest money that you'll find in terms of being able to borrow. As a result, though, banks don't make as much money on the arbitrage for sitting on cash, which there's a lot of cash, dry powder that's not being used. And so that is an area that I see as an opportunity for growth. In terms of interest rates from that perspective, for those that are seeking retirement in the next 10 years, I sure as heck hope it does go up for their sake. For those of us that are looking to buy homes, hopefully we can get in before that happens. But I guess I'd say I personally and professionally, I see it increasing. Absolutely.
Yeah.
Al, from a business valuation standpoint, any kind of closing remarks there of what you kind of see maybe M&A activity and valuations doing next year?
Yeah, I see us to picking back up, right? I mean, we're on a strong trend 2019 to going into 2020. Like we've talked about, a lot of capital on the sidelines, a lot, and private equity groups. And the worst thing that a private equity group, any type of investment group can have, or a public company, any company, is cash on their balance sheet. It means they don't have a good use for it. So the opportunity to come in and pick up companies, right, and grow them and get a substantial return, I think we're going to see a big increase. And it stopped, for the last 7 or 8 months. And I think we're going to see that pent up demand combined with a lot of capital on the sideline, combined with, low interest rates. And I think we're going to see a lot of this, especially as we move out of this and we get COVID in the rearview mirror through a vaccine and people get comfortable and they start coming back out, right? We don't have a relapse. I think we're going to see it's going to be a very strong M&A market, and we're already starting to see it. I mean, we deal with companies that reach out to us for potential acquisition targets, and that's certainly spiked in the last the last month or so. So I just see it as a really strong year. And again, we'll see what happens with capital gains. It's too late this year. I mean, there are a lot of deals that we're trying to get done and close by the end of the year, but we'll see what happens going into next year. But it should be a strong year. I think the Fed said they're going to keep interest rates low for a while. We really don't have any fear of inflation. Like Josh said, it's almost the opposite. No one's spending money. Yeah. So until we really start spending money and we start hitting capacity in supply, I don't think we have a whole lot of fear for inflation, and I think the Fed said that. So.
Yeah, Al, I'm going to ask Al a surprise question. It just something that came to my mind just listening to all of us talk about this. All right, so supply and demand, M&A transactions. Let's say they abolish capital gains taxes. Is that going to push the price up for the sale of assets or stock because people are going to have to pay higher taxes? And could that's an interesting point, isn't it?
Let me think about this. I think theoretically it would push prices down because you would take away more money.
Right.
Certainly give you an incentive to do it. Right. That would be my gut reaction, right? I think that would make logical sense because you're going to take away more money, so you don't have to take as much in sale.
But you got supply and demand, right? I mean,
yeah, you get supply and demand, so you got more coming on the market. Yeah.
Right. So I don't know.
Yeah, that's a good question. It'd be a good problem to have.
Well, real quick, I want to give everybody I know we're creeping up on time, so if anyone has questions, last minute one-offs, send them my way. In the meantime, I want the three panelists to get one takeaway point or conclusion point to close with. And think about that now. Gary, real quick, Robert had a question, and you touched on cost segregation studies earlier. And if anyone else has questions, throw them in the chat. But how long do you think it would take to do that on a small office building?
They can typically get those completed in a couple of weeks. Okay. I have some good reliable sources that do that work. And, as long as even if it's not completed until, let's say, February, right? And you purchased a building in 2020, it's still going to apply to 2020. So, I mean, obviously the sooner the better, but it doesn't take a lot of time to get those completed now.
All right. Gary, why don't you go ahead and give us, what's your takeaway point, conclusion point that you would want everyone to hear before we end?
Contact your CPA, do a tax projection, let them give you some ideas on some ways that you can save taxes for 2020, how that kind of dovetails into COVID. Be aware right now, the PPP grant forgiveness, the IRS is saying you're going to strip the expenses that were paid for that money. So in essence, it's going to be taxable until we hear from Congress. You might as well count on that. That could be a big hit for some people on taxes. So those are that would be my takeaway.
Joshua?
I think the biggest thing that I would say is a takeaway from a personal financial planning standpoint is know your number for retirement. And I think that really blends well with everything we've discussed today. Know the year, know the date, know the number, know how much you want to spend and the vision, and create a disciplined approach, a savings plan, a budget. Talk to an expert. Understand the investments, understand your liabilities and insurance and the stakeholders that exist within it, whether it's a C-suite inside of your business, co-owners, whether it's your family. I mean, that's the biggest takeaway. I would say it's never too early and it's never too late to consult.
So
Great. And Al?
Yeah, my takeaways are on those lines. I mean, there's a plan for everybody, but there's a different plan for everybody, depending on your circumstances and everything. And you don't know what you don't know, and come up with that plan, have a strategy, have discipline, check in on it quarterly, every 6 months, annually, and really, really take the time to get your house in order and do these tough things that, like Joshua talked about, insurance, talk about death, talk about what if scenarios, because there's nothing worse than when someone comes to us and it's just too late. There's nothing.
yep.
Not that I was a panelist, but I kind of reiterating Al's point. I think if you're not trying to sell yesterday, but you're saying, this is 2 to 3 years out, there's so much prep work involved and ways of building your valuation leading up to that point. You need to start now. And like I said at the beginning, we're education focused. It doesn't cost you anything except for maybe 15, 20, maybe 30 minutes to have just a introductory call and let us help you map out what, a strategy would look like. So that would be mine.
Great.
All right. Well, I'll let everyone go. If anyone has pressing questions after this, you know where to reach us. And I think we're going to have at least one more series next week before we take a little hiatus for the holidays. But we've really enjoyed having everyone on, and thank you for joining us today.
And
Thank you, John.
Andrew, one
Thank
thing.
you all.
If the people who participate, let us know what your thoughts are about the roundtable approach. If this is beneficial as opposed to a pure presentation, I think that would be good for us to know. And maybe this is something we could do more often.
Yeah, I think we can summarize everything too and send it back out. We'll post it on LinkedIn and post it in social media.
Yeah.
Something
I'm thinking in the future we do something similar to like this, and it's the Ask Me Anything type of panel where we want you to be involved and get your questions answered.
Yeah.
All right. Well, thanks everybody for joining us. I'm going to wrap it up.
Thanks, everybody.
Thank you.